Welcome back to the Deep Dive. Today we're digging into a fascinating company you asked us about, Astera Labs. That's ticker ALA. We've got a pile of sources here, articles, research, your notes.
Yeah, a good stack. And our job, as always, is to sift through it all, pull out the key insights, and give you a really clear picture of Astera Labs. They're right at the heart of AI and cloud connectivity.
Exactly. This is your shortcut to getting up to speed on ALAB. We'll cover what they do, their crazy growth, who's in charge, who owns the stock.
And what the market thinks. But there's a big question hanging over all of this, something that really comes through in these sources.
The valuation, right, it's sky high.
It really is. So the question we want you to keep in mind is, does the underlying business, the tech, the growth path, actually justify that price tag? It's that classic growth versus value debate, but with a very 2025 AI flavor.
Okay, let's dive in. First off, what exactly is Astera Labs? What's their core business?
Well, they design and sell semiconductor-based connectivity stuff. ICs, boards, modules. Think specialized chips for moving data really fast. Founded back in 2017 by Jitendra Mohan, Sanjay Gajendra, and Casey Morrison.
And their mission?
To smash bottlenecks, performance bottlenecks in systems drowning in data, especially AI and cloud data centers. Their vision is, to basically revolutionize how these systems connect and talk to each other.
Got it. And they're fabless, which is pretty important.
Super important. Means they design the chips, but they don't actually build them in giant factories or fabs. They outsource that manufacturing, mostly to big players like TSMC.
Which has upsides and downsides, I imagine.
Definitely. Upside, they're nimble, don't need billions for factories, can focus purely on design innovation. Big plus.
But the downside?
Dependency. They rely totally on those foundries for capacity, for quality, ties them right into global supply chain headaches, geopolitical stuff, which the sources definitely flag as a risk.
And their design process itself is interesting. The sources highlighted their use of cloud-based tools, EDA in the cloud.
Yeah, they were pioneers there. Using 100% cloud-based electronic design automation, think of it like having unlimited supercomputing power for designing chips on demand.
Which makes them faster.
Much faster. The sources said it cut like 3 to 4 months off their time to market, saved maybe 40% of the time from initial design to actually having a chip ready, plus better quality because they could run way more simulations. It's a big deal for speed.
Bell for speed. Okay, zooming out. The semiconductor industry they play in. It's massive, heading towards $1 trillion.
It's huge. And the engine driving it right now, generative AI, easily number one. The projections are nuts, like $150 billion just for Gen AI chips in 2025.
Wow. And Astra is also right in the sweet spot for the second biggest driver.
Cloud infrastructure, data centers, the hunger for compute power there is just relentless. And that needs super fast, reliable connections, PCs, phones, cars. They matter, but AI and cloud are the main events now.
And the tech itself is evolving fast. Advanced packaging, shift left, even AI designing AI chips.
Yep, all happening. Plus, surging demand for things like high bandwidth memory, HBM, crucial for AI. It's a fast-moving wave.
But not without hurdles. The sources listed quite a few challenges.
Oh yeah, big ones. Getting enough wafer capacity at the cutting edge is tough. R&D costs are astronomical. There's a serious global talent shortage, finding enough skilled engineers.
And the big picture stuff.
Geopolitics, tariffs, major worry for supply chains, general supply imbalances, regulations. It's complex.
So Astera Labs benefits from the AI boom, but they're fighting for talent, fighting for wafer space.
Exactly. And being fabless puts them right in the path of those supply chain and geopolitical risks. Their strategy, mentioned in the sources, of using multiple manufacturing vendors and sites, that's their attempt to mitigate things like those potential 2025 U.S. tariffs we'll talk more about.
Makes sense. How do they actually make money? The business model.
Mostly selling products. Those chips, boards, modules, services like support are smaller, maybe 10% historically. They do have long-term contracts with big customers, which helps predictability.
And the revenue growth.
Oh, sure.
It's just, well, off the charts.
It really is. Under $80 million in 2022, $115.8 million in 2023. Then boom, almost $400 million in 2024, 396.3 M to be exact.
And the latest quarter, Q1 2025.
$159.4 million. That's up 144% year over year. Just shows the intense demand from AI and cloud builds.
So the core value is fixing those data bottlenecks, their intelligent connectivity platform.
Right. It's the hardware plus their software, Cosmos. The goal really is to make those super expensive GPUs and AI chips work harder. The sources point out they often run at only 50% capacity because the connections between them are too slow. Astera wants to unlock that.
And they're moving from just selling parts to selling this whole platform.
Smart move. Adds more value, gets them deeper into customer systems, makes it harder for customers to switch away once they're designed in with that software layer. Management's also pushing diversification, ramping up new products like Scorpio, supposed to be over 10% of revenue this year.
Okay, let's break down that platform. What are the key product families doing inside the AI rack?
Right. First up, Aries. These are their PCIe and CXL smart retimers and gearboxes. The workhorse.
Retimer, like a signal booster.
Pretty much. Data signals degrade over distance. A retimer cleans it up, boosts it, sends it on its way. Aries can triple the reach for PCIe 6 signals, essential for connecting things reliably in massive systems.
Okay, so vital for getting data where it needs to go fast, like between GPUs or from GPU to server.
Exactly. They're called the gold standard in the sources for a reason. Fundamental for things like PCIe over optics, the gearbox part helps bridge different PCIe generations, like 5 and 6.
Got it. Next, Leo.
Leo tackles the memory wall. These are CXL memory controllers.
The memory wall. Explain that simply.
Imagine a super fast GPU starved for data because it can't access memory fast enough or get enough of it. That's the memory wall. CXL is a standard that lets processors share and access memory much more efficiently. Leo chips enable that.
Ah, okay. Like widening the pipe for the fuel. So Leo's critical for memory-hungry AI tasks.
You got it. Training, inferencing, requires huge amounts of memory bandwidth and capacity. Leo helps deliver that. They're shipping pre-production samples now to hyperscalers.
Then Scorpio.
Scorpio's their family of PCIe smart fabric switches. Think of these as the traffic controllers, the central nervous system connecting many GPUs or servers together in a high-speed fabric.
For building those massive GPU clusters needed for complex AI.
Precisely. And Astera was first out the gate with a PCIe Gen 6 switch here, giving them an edge. It's software-defined too, so big customers can tweak it. A key part of their plan to own the connectivity inside the rack.
And the last one, Taurus.
Taurus handles Ethernet connectivity, high-speed smart cable modules ready for 800 gigabit Ethernet.
Connecting switches to servers, switches to switches, the network backbone stuff.
Yeah, high bandwidth, low latency networking within the data center. Demand is growing as 800G networks roll out. Taurus saw good growth in Q1 too.
And gluing all this hardware together is the Cosmos software suite.
Crucial piece. It's not just a driver, it's the management layer. Customization, monitoring, optimizing the whole connectivity setup. For hyperscalers managing thousands of nodes, this visibility and control is huge. Really makes Astera a platform provider, not just a chip seller.
So, wrapping up products. It's a full suite, a one-stop shop ambition for AI rack connectivity. And they're already working on the next standards, PCIe 6, CXL 3.x, UA-Link.
That proactive approach, being first like with the Gen 6 switch, gets them designed in early. And once you're designed in, switching costs for the customer are massive.
Sticky business.
All right, we understand the tech. Who's steering the ship? The management team.
Led by the co-founders, Jitendra Mohan, CEO, Sanjay Gajendra, President COO, Casey Morrison, Chief Product Officer, Mike Tate is the CFO.
And they've got experience.
Oh, yeah.
Yeah.
Deep semiconductor backgrounds.
Mm-hmm.
Mohan, for example, 20-plus years at places like TI, National Semi. They successfully scaled Astera, delivered that growth, established Aries, and pioneered that cloud EDA thing. Plus, they've added experienced folks like Dr. Craig Barrett and Bethany Mayer to the board recently. What about pay and ownership? The sources mentioned some big numbers.
They did. Executive compensation in 2024 was eye-catching, over $50 million each for Mohan and Gajendra, mostly stock, like 99%. They also own significant chunks of the company, around 5% each.
So aligned with shareholders, but maybe a bit rich.
That's the tension. High ownership is good, creates an owner mentality, but the absolute dollar amounts are way above average for a company this size. It really puts pressure on them to deliver exceptional, sustained results to justify that kind of pay package.
And the board overall.
Looks strong, good mix of VC experience. Stefan Dijkerhoff from major investor Sutter Hill Ventures is key, and semiconductor execs from big names like Marvell, Intel, Broadcom. Manuel Alba is chairman.
That experience has got to be valuable.
Hugely. Strategic guidance, industry connections, crucial in this market. The board structure meets independence rules, standard stuff.
Governance seems pretty standard, too. Guidelines, audit committee, code of ethics.
Yeah, all the typical structures you'd expect, laid out in their proxy statements. Seems robust on paper.
But there is that concentration of ownership with founders and Sutter Hill.
True. Significant voting power rests with a small group. Doesn't mean governance is bad, but it means that group has a lot of influence. Effectiveness really depends on how responsive they are to all shareholders.
Let's talk culture. Sources described it as family-oriented, collaborative.
Emphasis on values like customer focus, innovation, integrity. They use phrases like act with intent, raise the bar together.
Why is culture so important here?
Talent, simple as that. In semiconductors, you live or die by your engineering talent, and there's a shortage. A good culture helps attract and keep those critical engineers. It's a competitive advantage. Plus, the focus on ethics and environment adds to their appeal.
Now, where does the money go? Capital allocation.
Overwhelmingly into R&D. It's aggressive. The sources show R&D was nearly 40% of revenue in 2022, and in Q1 2025, it hit $64.6 million, over 40% of revenue again.
Wow, that's high.
It is. Reflects their strategy. Innovate constantly. Stay ahead. Try to own the connectivity. That's the bet.
Any focus on buying other companies? M&A.
Not mentioned as a priority in these sources. Internal growth through R&D is the clear focus.
Dividends. Buybacks.
Nope. No mention of either. Every spare dollar seems plowed back into growth.
And being fables, they don't spend much on factories, right? CapEx is low.
Very low. Under $4 million in Q1 2025, mostly for labs and testing gear. They do watch hyperscaler CapEx closely, though, because customer spending directly drives their demand.
So the capital allocation story is fuel R&D like crazy.
Exactly. And they can do that because their balance sheet is, frankly, incredible. Over $924 million in cash and equivalents and zero debt as of Q1 2025. That's massive firepower and flexibility.
Okay, that strong balance sheet is a perfect segue into the financial health chapter. We know revenue growth is explosive.
It's the headline act. FY22 under ADMs, FY24 almost $400, $396 in the 3Ms, and Q1 25, $159 4MM, 144% year-over-year jump. Just incredible demand pull. Remember, you can find links to the source data in the description.
How about profitability? Is that growth translating?
Gross margins are very healthy and pretty consistent, hovering in the mid-70s percentage-wise, hit 76.4% in 2024, 74.9% in Q1 25. There is a tiny dip year-over-year in Q1, maybe product mix, but still really strong, shows pricing power.
And operating and net margins.
Yeah.
Bottom line stuff.
This is where Q1 2025 was a big milestone, according to the sources. While trailing margins might still be negative, Q1 saw a positive GAAP operating margin of 7.1%. Non-GAAP was much higher, 33.7%, mainly because GAAP includes stock-based compensation costs.
And the big news, they actually made a GAAP profit.
Yes. After posting losses before, they hit GAAP net income of $31.8 million in Q1 2025. That's a 20% GAAP net margin. Non-GAAP net income was almost $60 million. Reaching GAAP profitability is a really significant step, shows the business maturing and leveraging that revenue growth.
Let's quickly revisit that balance sheet. It sounds amazing.
It really is a standout feature. $924.7 million cash, no debt. Current assets over $1 billion versus current liabilities under $80 million.
Which means they're incredibly liquid.
Absolutely. The current ratio is almost 14, quick ratio near 13. They could pay off all their short-term bills many, many times over with just their ready cash. Exceptionally healthy.
And cash flow. Did they generate cash in Q1?
Yes. Positive net cash from operations, $10.05. CapEx was tiny, $0.39. So that resulted in positive free cash flow of $6.6 million for the quarter. Trailing 12 months FCF was over $108 million, generating positive operating cash and free cash flow, along with GAAP profit. That's a big milestone. Shows financial self-sufficiency starting to kick in. FCF is key for value, folks.
Okay, great context on the business and financials. How's the market viewing all this? Chapter 4. Market sentiment.
Generally positive, especially from Wall Street analysts. The consensus rating based on these sources is a buy.
What are analysts expecting price-wise?
The average one-year target seems to be landing somewhere between $100 and $112, suggesting, maybe 18-22% potential upside from where the stock was trading in late May 2025, according to the sources. Most analysts covering it are positive lots of buy or strong buy ratings.
Any recent analyst moves?
Yeah, May 2025 saw Morgan Stanley upgrade to overweight. Barclays, Needham kept their positive ratings. Susquehanna started neutral, but William Blair, Evercore, Roth all came out positive, mostly targeting $100 or more. So general bullishness there.
What about short sellers, people betting against ALAB?
It's moderate. Sources put short interest around 10.7 million shares, maybe 8.4% of the float, days to cover under 3. Not insignificant, but not extreme either. Shares seem easy to borrow if you want to short it.
And options traders.
The put-call ratio was below 1, around 0.74, which often signals more bullish bets calls than bearish ones, puts. But interestingly, the sources did mention some negative options patterns earlier in 2025, even with good news. Maybe hedging, maybe some speculation on downside risk. It's hard to say for sure.
So what's actually been moving the stock lately?
Number one positive driver, that Q1 earnings report, the massive revenue beat, the profitability beat, that really fired things up. Plus, ongoing news about their tech progress PCIe 6 stuff, the ALAB lab expansion.
Partnerships too, like with NVIDIA.
Yep. Collaborating with NVIDIA on NVLink, supporting the new UA-Link standard, that helps position them well in the AI ecosystem. Analyst upgrades obviously help, and seeing big institutions like Vanguard and AllianceBernstein increasing their stakes adds confidence.
But it hasn't been a smooth ride-up recently.
No. Interestingly, the stock dipped right after that great Q1 report. Maybe expectations were even higher for guidance or just profit-taking after a big run. Q2 guidance also hinted at higher operating costs, which might have spooked some.
And the insider selling we talked about earlier.
That definitely gets noticed. CEO, COO, CFO, General Counsel, Chairman, all selling shares in May 2025. The total amount sold recently, around $70 million, is significant.
Even if some sales were planned under those 10b5-1 rules.
Right. Even if planned, the volume makes people look twice. Is it just personal diversification and cashing in after the IPO and stock run-up? Plausible. Or do some investors see it as insiders thinking the stock is fully priced? Value investors typically prefer seeing insiders hold or buy if they think the stock is cheap, so it's a data point you have to weigh.
So you add that to the valuation worries, the slight gross margin dip. It paints a picture. Huge positives, but some caution flags.
Exactly. The stock's done well recently on the good news, but it's clearly sensitive to guidance misses, market shifts, and those underlying risks like tariffs.
Which leads us right into Chapter 5, ownership structure. Who owns ALAB?
Well, institutions own a big chunk, somewhere between 59% and 69%, depending on the source and timing. Hundreds of institutions, over 768, are listed.
Who are the big fish?
Major asset managers. Fidelity, FMR, looks like the largest institutional holder. Vanguard, AllianceBernstein, BlackRock, Atreides, D. Shaw, Jennison, Lord Abbett, Norges Bank, Norway's Sovereign Wealth Fund, Millennium. The usual suspects.
And what have they been doing lately? Buying or selling?
The overall trend recently seems to be accumulation. More institutions buying in, total shares held by institutions going up. We saw Vanguard and AllianceBernstein add significantly. Jennison and Norges Bank started big new positions.
But not universal buying.
No, some mixed signals at the very top. BlackRock apparently trimmed its stake a bit in its latest filing. Atreides fluctuated. So, while the broad trend is positive institutional interest, the big players are actively managing their positions. The sources mentioned a fund sentiment score suggesting accumulation overall.
Okay, now insiders, founders, management.
They hold a significant stake too, maybe 15% to 33% collectively. CEO Mohan and COO Gajendra around 5-6% each. And crucially, Stefan Dijkerhoff from Sutter Hill Ventures holds over 10%, plus Sutter Hill itself holds another 8%. Shows that strong continuing VC influence. CFO, General Counsel, also holds shares.
And back to those insider sales from an ownership view.
Yeah, the $70 million sold recently by top insiders in May 2025 stands out. Even with 10b5-1 plans, it's a lot of selling volume relative to their holdings. Again, high ownership is good for alignment, but seeing executives cash out significant amounts naturally raises questions for investors about timing and valuation perception.
Finally, shareholder rights within this structure.
Standard stuff, mostly. Voting rights, director nominations possible, board accountability mechanisms are there on paper via the proxy, but that founder VC concentration means a small group controls a large voting block, which inevitably gives them outsized influence on outcomes.
Okay, we've got a good handle on the business, financials, sentiment, ownership. Let's pull it together with risks and opportunities. Chapter 6, risk assessment using SWOT.
Right, a quick summary. Strengths. We've hit these amazing growth, innovative AI cloud-focused products, key customer wins, tech leadership, Cosmos software, cloud ED advantage, high gross margins.
Weaknesses, gross margin pressure from mix shifts, customer concentration, hyperscalers, those very high valuation multiples, fables dependency risks. Historically negative net income, though now positive.
Opportunities. Huge AI cloud market growth, adoption of new standards, CXL, PCI 6, potential for more products, expanding the customer base, more silicon needed per AI platform generally.
Now, the threats. Let's dig in here. Competition first.
It's fierce. They're up against giants, Broadcom, Marvell, Intel with way deeper pockets, plus specialized players like Credo. Tech changes fast. Products get outdated. Constant battle.
And a big one flagged in the sources. geopolitics, and those potential 2025 U.S. tariffs.
This is a major potential headache. The sources spelled out how it could hurt Astera.
How specifically?
Could raise costs for their foundry partners building fabs in the U.S., costs that might get passed to Astera, direct tariffs on components or finished goods raise their costs, supply chain shifts forced by tariffs cause disruption, and maybe most importantly, if tariffs raise hyperscaler infrastructure costs, those customers might cut back their spending, hitting Astera's demand directly. Their multi-sourcing helps a bit, but major tariffs would still sting.
Then there's the general semiconductor supply chain risk.
Always there for a fabless company.
Yeah.
Relies on foundries for capacity, quality, yields. Vulnerable to disruptions anywhere in that complex global chain.
Talent shortage still a threat.
Absolutely. Critical risk for an R&D heavy company. If they can't hire and keep top engineers, innovation slows down.
And the risk of their tech becoming obsolete.
Constant pressure. That high R&D spend isn't optional. They have to keep churning out next-gen products or they fall behind fast. Economic downturns are also a background risk, could hit customer spending, though hyperscaler plans seem strong for now.
Cybersecurity.
Always a risk for tech companies. Data breaches, IP theft. Sources say they have policies, use NIST framework, audit committee oversees it, but the threat's always there.
And product defects.
Complex chips can have bugs, leads to returns, warranty costs, damages reputation. It's an inherent risk in this business.
So summing up the risks.
High growth, high risk industry, lots of standard tech risks, but also specific ones for Astera like fabless dependency, customer concentration, and the very real threat of tariffs impacting them or their customers.
Okay, we've covered a ton of ground from these sources on Astera Labs.
Yeah, we've seen a company clearly capitalizing on the massive AI and cloud build-out. They've got specialized, innovative connectivity solutions, Aries, Leo, Scorpio, Taurus, plus Cosmos, targeting key bottlenecks. They really do want to, as the sources say, own the connectivity infrastructure within the AI rack.
Financially, the story is explosive revenue growth, consistently high gross margins, and that really important milestone in Q1 2025, achieving GAAP net profitability and positive free cash flow. Plus, that fortress balance sheet, tons of cash, zero debt.
Management's experienced, founders own a lot of stock, which aligns them well, although that high comp and the recent insider selling are things to watch. The board seems solid.
And the market, analysts, institutions, they seem largely bought into the growth story, hence the positive sentiment.
And this is the big but, running through the sources, the valuation is extremely high. PE over 90, price to sales over 31. These aren't value stock numbers. The market is pricing in sustained, near-perfect execution and continued massive growth.
Which brings us right back to that central question, the hook we teased. Given today's price, is Astera Labs' amazing growth and tech leadership enough to justify this premium valuation?
Or, looking through a value lens, as some sources implicitly do, is it a case of growth at an unreasonable price? Can their developing competitive advantages, the software integration, potential switching costs, truly protect them and deliver high returns long-term against huge competitors, especially with those significant risks around supply chains, tariffs, and the constant need to innovate?
It really is that tension, incredible opportunity versus significant risk, reflected in a valuation that demands the company keep hitting home runs. That's the core dilemma for anyone looking at ALAB right now.
Definitely. And that wraps up our analysis based solely on the source materials you provided for this deep dive. We hope distilling these insights was helpful.
Remember, this discussion focused only on the information within those sources and isn't financial advice. If you found this valuable, please consider subscribing to Stock Analytics AI on YouTube. Members get priority deep dives like this one.
Thanks for tuning in.
We'll catch you on the next deep dive.